This is the current federal tax developments for the week of January the 19th, 2026. Ed Zollers. And we're welcoming you back to our weekly update. We have a whole lot of guidance this week involving one major circuit court decision that's going to create a split, depending upon where you live, on self-employment tax regarding partnerships. We're going to talk about a new statutory construction on bonus depreciation that followed the One Big Beautiful Bill Act and IRS guidance in that area, and a number of other updates. So first, we're going to cover 5 primary developments today. We're going to first cover the Fifth Circuit's vacation of the Sirius Solutions tax court decision, which has revived the limited liability test for limited partners. We'll also discuss a whistleblower case that clarified that voluntary taxpayer corrections don't count as collected proceeds. Notice 2026-11 that talks about how we're handling the transition back to what will now be permanent 100% bonus depreciation. Also notice 2026-13, which updated the safe harbor explanation for notices to plan participants under 402F when they're receiving a rollover, they're receiving a distribution that is a qualified rollover distribution from the plan. And we'll also talk about Revenue Procedure 2026-8, which is the first overhaul of the group exemption letters in 40 years. Plus, we'll talk quickly about a bit of clarification on the tax status of military housing allowances, specifically the supplemental military housing allowance that was received this year. Let's start out here with what we're going to have here, our third slide. And it's going to talk about supplementary tax liability for limited partners, the Sirius Solutions case. In Sirius Solutions, LLLP versus the Commissioner, this is case number 24-60240, issued, the opinion came down from the Fifth Circuit on Friday night. Basically came down on Friday after I had left the office. Everybody else was pretty much gone, right? Nobody was paying attention, but it came out late on Friday. This is a major win for taxpayers in the Fifth Circuit, at least if you have a limited partnership. The court vacated the tax court's decision in Sirius Solution, effectively rejecting a functional analysis test for limited partners that we saw established even for state law limited partners in the Sorabon case. The Fifth Circuit has gone for what they see as a strict statutory interpretation of Section 1402A13, following what's effectively a textualist construction. Or we might say, because I think I see why this opinion took so long to get out, we got a quasi-modified structure, so we'll talk a little bit about that. So let's take a look at the case overview, the procedural history. Now, Sirius is a Delaware limited liability limited partnership that had a general partner and several individual limited partners. The dispute was that essentially the entity excluded limited partners' distributive shares from self-employment tax. The IRS audited and reclassified this income, arguing that none of the partners counted as limited partners because they were active in the business. Arguably, they were the whole business, was what it was. In the prior ruling that was appealed to the Fifth Circuit, the tax court has upheld the IRS adjustment, relying on its previous decision in Sorabon Capital Partners. The court applied a functional inquiry and effectively said that if you act like a general partner, that is, you are actively involved in the business, so you aren't passive, you are going to be taxed like one. Now, the Fifth Circuit Court of Appeals vacated this. They held that a limited partner is a partner in a state law limited partnership, or let's say a limited partner is a state law limited partner in a state law limited partnership who possesses limited liability. So going back to, a strict construction view of this. We'll get to the pros and cons of that, but there is a reason, I think, because it's kind of interesting that this case was argued nearly a year ago. And it took the Fifth Circuit panel 11 months to give us this decision. So it wasn't one they came out with really quickly. Now let's take a look at the textualism over the functionalism decision here. Why are we doing, the court went for what they will describe as a textualist construction. Under the logic, the court looked at the plain meaning of the text in 1977, the year the statute was enacted. Now, we say that if you read the tax court decision in Sorbonne, you're going to discover that the tax court claims they're doing a plain text, basically plain meaning of the text in 1977. That's one of the problems I've had ever since the beginning of this kind of time-linked textualism, is that now we're going back to, in this case, 1977, nearly 50 years ago, and trying to figure out what something meant 50 years ago, this being decided by, justices, even though they're not young, they weren't exactly, the people that were making these decisions back in 1977. So we have an interesting issue there. Now, the court reviewed dictionaries from that era, and it found the defining characteristic was limited liability, not lack of participation in their definitions. Now, I should say this is a split decision, and the dissenting judge on the panel is very critical of saying that what they did here was they edited the decisions to only include the part that talked about limited liability and to specifically downplay or even remove anything that said anything about not participating in management. I'll let you read everything and you can make your decisions. We'll just say the dissent is not a nice one, right? It is clear there was a major disagreement over this in this case. But in any event, the majority opinion, 2 of the 3 judges, that's also interesting. Whenever you have a split decision like this, I would not be surprised to see the IRS initially try for a rehearing en banc. That would be where the entire Fifth Circuit would hear the case again. Then the next issue, will they take Supreme Court? We're not sure. But a 2-1 decision, again, it's a randomly chosen panel. So it's possible that, the random choice was just unlucky. And you got the only judge on the entire Fifth Circuit who would think that the IRS rule was correct. But it's also possible that this really means that it was pure luck in a sense that it may be very closely split. And this particular panel just magically got 2 on the side saying we want to go textualist. So we'll have to take a look and see what happens there. Again, we have no idea what the IRS's next move is because, as I said, the opinion came down very late on Friday. So there's not really been any time to do this. Now, the court did, though, take up something which basically Sirius had made a big point about in their brief about the case. And they said for over 40 years, the IRS instructions for Form 1065 defined a limited partner strictly by liability limits. And the courts noted that law books teamed with examples of taxpayers punished for ignoring instructions, so the IRS cannot ignore its own longstanding guidance now. I will tell you that the dissent says the section said generally, you're a limited partner if you have limited liability, etc. So, as we say, now I'm a little more toward the majority panel on that one because it seemed generally, but we never found out what the exception was. So, a little tough to go, but we'll look at that. But I am also in the line that instructions aren't really regulatory guidance, and I do think the majority overreached by quoting Loper-Bright here. Trying to go down a Loper-Bright analysis. That's interesting. Anyway, that whole bit about what point instructions have and publications have has always been messy at best. Officially, they don't bind the service. So, we'll have to see how that goes. The tax court toyed with getting rid of that in a case a couple of years ago, but didn't actually do it. Now, the majority, of course, went after flaws in the passive investment argument. They did note, again, a point Sirius made a big part of pointing out, that there is a statutory construction issue. Section 1402A13 carves out guaranteed payments for services actually rendered. The court reasoned that if limited partners were required to be passive to qualify for the exclusion, then there'd be no need for this carve-out, because by doing services and actively rendering them, you don't need this carve-out because you're no longer a limited partner. The statute, they said, clearly contemplates that limited partners might provide services and be separately compensated for them, which that was the case in Sirius. Indirectly, the general partner was, as I recall, an LLC, And the basically the partners in Sirius were the partners in a general partnership, and the funds that went through there were meant to pay for the services. So it's kind of an indirect guaranteed payment in their case. Now, the IRS argued that the key issue, and so the tax court, the phrase was limited partner as such, and it implies a functional test. The dissenting justice says, yeah, as such as a meaning. The majority panel agreed that it had a meaning, right? It said as such is recursive. It handles dual status partners. Somebody that is both a general partner and a limited partner, assuring they are taxed correctly in each capacity. And that was something, even the proposed regs that never became final. That's kind of started this whole battle out because they were mainly pulled back by criticism from then Speaker Newt Gingrich. Then Congress passed a bill to stop them from doing anything with them for a year and promptly didn't themselves settle the matter because that you could be held accountable for. Congress does not like touching these things. So they stopped it. That was great, got the news bite, and then totally ignored doing anything about it because that would require making a decision. That would require risking the ire of either the taxpayers who are paying these taxes or risking the ire of the AARP for putting Social Security at risk. And if you're a congressperson, you especially don't like that second option, right? Because, over 65s vote. And that's not a good thing to upset that group. So Congress, as normal, chickened out. Well, they chickened out by inaction because that's the easiest way to chicken out. Always is. In any event, that's where we stand here. But yeah, that was it. And again, the proposed regs, back that were never adopted, specifically recognized that there were situations where you could be issued a general partnership interest and a limited partnership interest. And you then could, you could basically be treated as a limited partner for that other capacity. Now, we're going to take a look here at the role of state law and liability. And the majority said, while federal law defines the tax, it looks to the state law to create the legal interest. Now, the court held that we must look to state law to see if the partner has limited liabilities. If they do, they fit the federal definition. Now, this is where it gets tricky. The law never says limited liability. So what the majority panel is doing and why they're doing this is because there is a big problem that sits out if we go textualist all the way. That big problem is called LLCs. And I'll briefly discuss that problem at the end of this. But what we have there is, so what they're saying is, well, limited partner, going to look at a meaning for that by looking at, what it meant to people generally. Ignoring the fact that limited partner was referenced and defined in every state's statutes. There was the state definition, right, that was there. That is a definition the courts had used for a long time prior to Rankmeyer. Take a look at the Norwood case, and you'll see that they were using that definition. Norwood didn't look to see whether you had a limited liability. Norwood looked to see whether or not the partner essentially was in a limited partnership. So it's a limited partnership guy, you cannot be a limited partner. Okay. But in any event, so that's why the court's going and getting a little tenuous here. Like I said, there's a reason that this opinion took 11 months to get. Because they're trying to avoid a big problem. And they then don't talk about the problem except in a footnote, which simply says we're not talking about the problem. So we'll get there. But in any event, so under state law, does this person, even if they're not called a limited partner, do they have limited liability? Now, I think the court messes up in their opinion because they go back and re-edit it properly. Because it does still say you must be a limited partner. You must be a limited partner in a state law limited partnership. It's like, I think you guys missed the re-edit to take that part out because that's where the problem's going to come. But it is what it says right now, so we're going to leave it where it's at. And they say that actually twice. I think it's even it may have been even there 3 times the clause shows up, which is interesting because they took a lot of work to phrase their test this way. We do that. Now, so they're saying under this thing, so in theory, if we ignore their statements that it has to be a state law limited partnership, state law limited partner, state law limited partnership, There's it, and also we don't really have a good justification for when we'll take a state definition and when we won't. Now remember, Sirius is all for just take the state definition. That'll solve their problem entirely. But the court's getting a little nervous about what we might call, basically collateral damage, which could be way bigger than the number of limited partnerships involved in this. So we're taking a look at that. Now, the IRS argued that modern limited partnership laws allow limited partners to participate in control, making them limited in name only. This was not something we saw in 1977. The court rejected that view, stating that regulatory changes in state law do not argue the federal tax definition unless Congress updates the code. So we've got a really interesting fine line about when we do the state and when we don't. As I said, Sirius is really consistent. Sirius says state law definitions, period. That's all we care about. Sirius is very consistent. The panel is the panel is really worried. And like I said, there's a reason it took this long to get this decision out. Now, the big thing to represent at this point, though, is this is indirectly in conflict with the tax court's approach in Sorobron and Rankmeyer. Now, Rankmeyer and Sorobron are reported tax court decisions. That means outside the Fifth Circuit, nothing has changed. Unless the tax court's, at first case comes up to, oh my gosh, we looked at this and wow, we understand we're wrong. Unlikely we're going to see that, especially as hard as they're fighting on the issue about whether or not, the 90-day deadline for filing your in tax court when you have a notice of deficiency, the statutory notice of deficiency, whether or not equitable relief is available there. They're losing that in a lot of places and they're still fighting it. So I don't think they're going to give up on this right away. I'll just say it that way. So in other places right now, keep your eye on this because we do have other cases coming up that will hit other circuits. Keep your eye on it. But if you're in the Fifth Circuit for now, assuming no en banc rehearing takes place, this is the law in the Fifth. So in the Fifth Circuit, a limited partner in a limited partnership under state law is going to be exempt from self-employment tax. That will not be self-employment income to them. That's going to the Fifth Circuit. That's how it's defined. Flip side of that is, if your client is in any other circuit right now, the tax court is going to rule that they're subject to it. They'll use the functional test. So your client has to understand that if they're saying, wow, it's one here, now we're going to do it, we're going to take the position. If they're examined, you're effectively committed to going to the Court of Appeals. And that's going to be a little costly. So, your clients in that case may want to file protective claims for refund, but they might not want to take the position yet until we see if what the first or the second, the ninth, the eighth, etc. circuits do as they approach this issue. But for taxes in the Fifth Circuit, and that's Texas, Louisiana, and Mississippi, the functional analysis test is dead for state law limited partnerships. We do not know what it means for LLCs. LLCs, does that mean every LLC member is exempt because we only look at limited liability? Or does it mean none of them can ever claim an exemption because they're not in a limited partnership? And honestly, I like I said, I think somebody thought of this. They went back to rewrite the opinion, but they have sentences that just aren't good saying our ruling is that just doesn't really work under that scenario. So I have concerns about this. Now, the IRS will definitely continue to litigate this in other circuits. I don't think there's any question about that. We already have cases before us. Now, and as Judge Graves notes, who was a dissenter, he argued strongly this is just a big loophole for service partners to avoid self-employment tax. It shouldn't be allowed to stand, and he starts raising questions about those other entity types, which again is where we get interesting. As I said, the big concern is if you take it, a pure literalist approach says that 1402A13 said limited partners. Limited partners are, like a corporation at the base level, are something defined by state law. Now, we have associations right, under federal law that we will treat as federal tax corporations, and they include corporations under state law. And we always just say, we look at whether the state, treats it as a corporation under its regular legal principles. And the same thing would be true here. It'd be the argument is 1402 should be a limited partner. Now, as such, is what got us to say, well, maybe the state definition isn't quite right, and we don't blindly follow it. But if we do just follow it, and the case that can help explain that is the year 2000 Norwood case, Norwood versus Commissioners, a tax court memorandum case, I think, tax court memo 2000-84. That was a case of a general partner saying, arguing for a functional test. I don't do anything. I'm not involved. I'm a mere investor. I should be able to not have to pay self-employment tax, right? Because I'm like a limited partner, right? Functionally, I'm a limited partner. And the tax court said, sorry, this is we use state law definitions and have for ages in this area. Right? That was a 2000 case. Now, I can argue that obviously the tax court appeared to reverse that view, at least if it's an LLC. And there's never been a good explanation why LLCs are different than, what we talk about the case in Norwood, because, check the box merely says you make the election or LLC, you'll be treated as if you were a partnership. Nothing says we're going to treat you as a limited partnership. We're going to treat you as if you were a partnership. And remember, partners under 1402A13 generally are going to pay self-employment tax on any business income generated, for a business that was carried on by the partnership. So bottom line, it would seem you would say that LLC members would just have to pay it because they should have formed as a limited partnership if they wanted to avoid this. Again, the court never. So there's a lot of really how do these pieces fit together problems here. And this takes it a bit further. Rankmeyer, in theory, appeared to be offering us we're going to just use this functional test for everything. The Fifth Circuit says, no, I don't see why we would do that. And, but the problem is because we have been living with Rankmeyer now, effectively, since 2011, so 14 years, we've been living with Rankmeyer on LLCs. It's messier, as it would say. So anyway, we'll just have to see what happens going forward in this area. But we do have the nice little, infographic that you can show here. This, in essence, looks at, on this case, we're looking at the divergence, essentially. The IRS tax court focuses on activity. The left side of what you see if you're looking at the infographic, under the tax court, we're looking solely at a functional test. How much are you involved? And by the way, in this case, the outcome involved $5.9 million, worth of self-employment income. Okay. In the Fifth Circuit, we're looking at a limited liability test for a state law limited partnership, right? And so that's a little different. There is a very good chance that at least one other circuit will go along with the Fifth, assuming that the Fifth doesn't get overturned in Bonk. So we may see this come in others. Right now, we've really got two different views of this. The functional test, which is true outside the Fifth for the moment, and the limited liability test inside the Fifth. As I said, I would strongly consider at this point, if you have a state law limited partnership and you've got individuals in there who actively participate, if they want to take the position that it's not SE income, then they take the position. It's probably got reasonable basis based on the Fifth Circuit ruling, but probably not substantial authority outside the Fifth Circuit. I would suggest if your client doesn't want to take the risk of being examined and having to defend it, then what you could do is file this, then follow up with a protective claim for refund. Indicate specifically, we're looking at this issue, which just got raised, with the Fifth Circuit decision in the Sirius case about whether or not, because this is a state law limited partnership, they're a state law limited partner. We're going to look at whether or not that, in essence, is going to apply here. And if it does, we want our money back with interest. Please, we want some money back at the end of the day. So you file that. Again, with protective claims, in theory, the IRS does not have to hold them, but they generally do, because otherwise you'd have to file suit in court, and now they're fighting it multiple places. It's just not worth the risk. So the service usually will agree to sit on it, and then we just wait for this to become clear, at least in your circuit, to see how the IRS would react. In your circuit, if your circuit rules ahead, then you will tell the IRS, I think it's time to pay us up. They may or may not agree, but if they don't agree, then you would sue, and we'd be off and running. Next up, we're going to talk about whistleblower awards and what's called the collected proceeds. Now, this case, like a lot of whistleblower cases, doesn't tell us who the person is because that's anonymous. So it's whistleblower 11,099-13W versus Commissioner. Tax Random Decision 2026-5 issued on January the 13th. This is an administrative procedure issue, but we have a memo of opinion clarifying what constitutes collected proceeds for purposes of getting an award for blowing the whistle on a tax cheat. So let's talk about this case. The case began in 2008 when the whistleblower filed Form 211 to turn in a tax cheat, his employer. Right. The allegation was that the corporation in question was abusing the LIFO inventory method. Specifically, the whistleblower claimed the target, basically that what would be the target of the investigation in this case was using coupled year-end trades to artificially inflate costs of goods sold and defer their tax indefinitely. Now, the IRS did audit this corporation, right, for multiple years, 2006 to 2009. What happened was the IRS could not substantiate the claims that were made. And this guy really didn't have the background. The whistleblower lacked the necessary accounting experience and failed to provide specific evidence like, paperwork flowcharts or names of third parties that were involved in this supposed, basically artificial inventory inflation that was taking place. He couldn't name names or do anything like that, and they couldn't find any. So they made no adjustments to the inventory or cost of goods sold based on that information. However, while the audit was ongoing, and this is where things get more interesting, the corporation voluntarily filed for a change of accounting method under 3115 to change its accounting method from LIFO to FIFO. Right? Under Section 481A, the cumulative effect of the change, the company recognized over $9 billion in income to recognize recapture the LIFO reserve. Now, that could be a totally legitimate LIFO reserve. Or it could be that there were problems in there. Remember, all the IRS said was that they couldn't prove the allegation. Doesn't mean something wasn't happening. It just, they were unable to prove it. And so the exam closed with no assessment. Now, of course, the taxpayer, the guy applying for this basically this reward, what he said was, look, he said, this occurred because we had this evidence out here, and they decided it wasn't worth the risk anymore. So despite that recognition of income, the whistleblower office denied the award. The reasoning is simple, but it's very strict. The information provided did not result in the collection proceeds because the IRS did not have an administrative action that caused the collection. Ultimately, this was a voluntary action on the part of the taxpayer. So no proceeds collected, no reward to be given. So essentially, voluntary versus enforced collection is the key. Now, the whistleblower alleged that the target entity, the targeted corporation, which is what the IRS was looking at, that they used LIFO to inflate their cost of goods sold, which of course reduced their income during years in question. As I said, audit team could not substantiate any of this, right? They made no adjustment. However, there was that 3115 that was filed. Now, what the whistleblower is going to claim is that this voluntary switch was voluntary in name only. It was caused by the investigation. somebody was nosing around on what was going on with their LIFO inventory. And even though they hadn't found the smoking gun yet, they in essence, were probably afraid that this would be looked at in more detail. So the theory is they went ahead and switched. Well, what the court did in this case was it relied on a couple of previous cases, Whistleblower 16158-14W, again anonymous, and the Lewis case. And the key finding of these are, including Lewis, was, collected proceeds must result from administrative or judicial action. A taxpayer filing a return is not going to be self-reported amounts on original return, even if that return is a change in accounting method, are not proceeds collected by the IRS under this program. A voluntary compliance act, even if induced by fear of audit, does not qualify. So, as the court would say, there's no evidence, essentially, right, in this case. And the real catch was the corporation filed a non-compulsory 3115 initiating the change, paying the $9 billion. The examination team never expanded the audit to the years covered by the method change. And as the court finally said, even if you did cause the change, it's immaterial. Reported paid tax is not collection proceeds. I don't care if you scared them into doing it. Tough luck. It's got to come off on exam, right? And in the years that were under exam, the IRS was unable to get to the point where they were comfortable making an assessment. Okay. Now, practical takeaways from this at the end of the day. There is a very high bar for awards, right? And the IRS must be the one to actually take direct action. They must assess the deficiency and collect it. If they don't do both of those, you don't have a reward scenario per the tax court. Fundamentally, if your tip merely caused a company to get nervous and fix their books going forward, remember, they didn't go back and amend the prior return. They did a change of accounting method, an automatic one on the to be filed return. That was a voluntary action on a return that had not yet been filed. That's not going to work. You can't get a whistleblower award from that. Life may be unfair, but hey, that's where you get. Now let's talk about the bonus depreciation changes of the One Big Beautiful Bill Act. That bill passed last July, of course, went back and reinstated 100% bonus depreciation. So this was notice 2026-11. It came out on January the 14th. So again, the One Big Beautiful Bill Act, enacted back in July, it permanently stopped the phase down of bonus depreciation and reset the number to 100% with no future phase outs coming in. Right now, this was for property acquired and placed in service after January 19, 2025. Okay. It essentially, the requirement the property be placed in service for January 1st, 2027 was repealed. And so we have all of that. So bottom line, IRS issued this notice saying, we're going to correct our guidance, but we realize you guys are getting ready to file returns. So we're going to give you some guidance to work with now. And what Notice 2026-11 tells us is a couple of things. Until we get final regs, this notice tells you how to read the existing regs. Because a lot of stuff here, is basically just the existing regs will cover it. That includes date acquired, which really only matters when we change the amount of bonus depreciation. Date placed in service is always an issue. Do we take it this year or another year? But date acquired is the thing that sets which percentage you're going to get, right? It's got to be acquired and placed in service after January 19th of 2025, right? Now, what they say is go back to Reg 1.168K-2 mainly, And wherever those regulations say September 27th, 2017, that was basically the last day before the TCJA rules became effective. And you just substitute January 19th, 2025 there, the last day before the OBBBA 100% rule comes into play. And wherever the regs discuss Apple percentages, the phase down, all of those rates that were going down from 80% to 20 to 0, they just took that table, put 100% every one of them. They said, at least for right now, reading them, I'm hoping the final regs will just get rid of that section. But they said, for right now, change every one of those percentages to 100%. So we're going to get bonus at this point. Right. Now, the written contracts, that's also in Regulation 1.168K-2. Property is not treated as acquired after the date a written binding contract is entered into. And when you go back to the regs, which they direct you to here, just with updating the date that we're looking at here, which is January 19, 2025, if you have a binding contract to acquire something before January 19th, you're going to get the phase down bonus depreciation. However, even if you place it in service January 20th or later. However, a binding written contract, or a written binding contract, they like to do it the other way, is considered to exist or not considered to exist if your contract essentially says, I can get out of my commitment to buy this piece of equipment. And if I do that, the most I would have to pay is less than 5% of the purchase price that I signed on the contract. So if you'd agreed to buy a $100,000 piece of equipment, but the contract said when you signed it that, if you decide not to go forward with it, maybe, you're going to forfeit the deposit of $4,000 you put down. That's not that's not a binding contract. And that's going to allow you to push past, January 19th, assuming that you placed it in service or you basically completed and did a full-blown commitment after January 20th or later. That's the key. It references you in there. Okay. It also clarifies we did get a new class of assets that can qualify for bonus. Qualified sound recording productions. There's a reference there as to it's now qualified property. The date it's placed in service is at its initial release or broadcast, and it is acquired when principal recording commences. So this is the same treatment we get for film and television productions that previously qualified. Sound recordings didn't. They're now in the mix, so keep that in mind. There is there's a specific transition rule under 168K10 that you could, for the first tax year after January 19, 2025, you can elect a 40%, the old phase down rate, instead of the new 100%. And again, this might be useful for managing NOLs, a few other special cases where you might want to use the lower bonus rate. The opt-out is the standard election to opt out of bonus entirely remains available, but there's a separate option you've got here, in essence, to just, follow the reg procedures, but substitute the new statutory dates and percentages for opting to keep the old lower percentage. Again, we had a similar rule that was in effect back when we had, went to 100% under the Tax Cuts and Jobs Act, which again has had a weird date that we had to work with. Key issue for this notice, you can rely on this notice for taxable years beginning before the proposed regs are published. If you're calendar year, that means you rely on the notice for 25 and 26, right? Or I should say, because, for taxes beginning before the proposed regs are published, well, 2026 year has now begun already. Proposed regs, therefore, we're basically, proposed regs haven't been published yet. So it means for 25 and 26, we will follow this notice. The proposed regs could change rules. And that's what they're holding up here. If they do change rules, then with the proposed regs, you might have to start following those. And you don't have to actually follow this guidance. If you have other interpretations you believe are better interpretations of the law, you can do that, right? But if you decide to avail yourself of this, safe harbor reliance rule, you have to rely on it for everything. You cannot pick and choose. Provisions under Notice 2026-11, which is when you go back and you just amend the regs. You can't pick and choose, well, I like it for this, but I don't like it for that. right? Maybe I like it for, let's say self-constructed property where there is a 10% of cost rule, but I don't like it on the sound recording because I don't think it should be when I started recording. Maybe I really think it'd be very similar to 10% rule. No, you can't pick and choose like that, right? You're going to, if you write, must apply it its entirety to all property. Otherwise, the IRS can attack you even on the stuff that's in line with the notice. And again, we have our nice little, here we have our infographic that essentially outlines for you both the impending cliff that was there, where it's going to go down dramatically, then the One Big Beautiful Bill Act that took over, which restored the 100% and adds our sound recordings. So a nice summary of all the changes here on the infographic. Next up, we're going to talk about the Section 402F Safe Harbor explanations and the fact that we have updated explanations in the updated explanations provided for us in Notice 2026-13, issued on January 15, 2026. Okay. Now, this was the updated safe harbor explanations for eligible rollover distributions, and it's mainly reacting to the Secure 2.0 Act and what's there. Okay. Now, general rule under this Notice 2026-13, but under the law in general, plan administrators must provide a written explanation within a reasonable time period between 30 and 180 days before giving a taxpayer an eligible rollover distribution. So the taxpayer understands what their options are. This notice now replaces the prior notice, 2020-62, which had, the previous safe harbor notices. If you have clients that are plan administrators, their template documents should be updated immediately to conform to the new safe harbor guidance if they were doing the safe harbor, work. Again, it was driven both by this and a GAO report that found the prior notices a bit too confusing. And they made some recommendations for improving them. Those recommendations are generally taken into account in this Notice 2026-13. Now, this notice also, it updates for the law changes, right? So there's Secure 2.0 changes, like exceptions to the additional 10% tax on early distributions. This notice reflects those new exceptions to 10% penalty. That's like emergency expenses, domestic abuse victims, if you're terminally ill, and disaster recoveries. Now, generally, some of these exceptions are not rollover distributions, but you're still going to include a description in there, right? In this case. So those that are not rollover distributions, an example of that are emergency expenses, which were added there. Those do not require this notice because, again, this notice is required if the amount could be rolled over. And these are options. And generally what it explains to taxpayers is that you could roll it over, either do a direct, trustee to trustee transfer, which case then every dollar would go. You could take the money out and within 60 days, basically deposit the entire balance. But the problem there is it will generally require a 20% withholding, which is for the, withholding because they figure you're going to pay tax. And that's mandatory. So if you go that route, you got to make up the 20%. You're paying tax on 20% and likely paying the 10% penalty on 20%. If you're not over 59, if you're not over 59 and a half, you're probably paying that out. Right. So you have to be aware of that. Or, you basically just take the money, pay the tax and not worry about putting it back in an account. So that's there. Now, there are some required minimum distribution updates that are made to this. This notice updates explanations to reflect the Secure 2.0 Apple age for required minimum distributions. As you should be aware, that age increased to 73 for those who turned 72 after 2022, and its calculated rise 75 for those obtaining age 74 after 2032. It's a little bit weird. And by the way, we'll just say that second date, it might be a year later than that. We just have to kind of say the IRS is indirectly taking the position that's a year later. But yeah, we have a whole bunch of mess. So we're just going to go there. Now, for Roth accounts, there's significant changes regarding designated Roth accounts. The Roth accounts clarified that requirement distribution instead of death benefit requirements do not apply to these accounts during their lifetime. So plan-based Roths are in line with Roth IRAs regarding lifetime distributions, which is good news. Also, for surviving spouses, the updated safe harbor explanation covers both the new election under 401A9B IV, right, who can elect to be treated as the employee for requirement distribution purposes, which may allow them to delay distribution based on their own age rather than the decedent's age, even if the funds are in the plan. And finally, a practical administrative update. The threshold for mandatory involuntary distributions, cash outs without participant consent, is increased. That limit moved from 5,000 to 7,000. If a participant leaves a job with a balance of this amount, the plan can force a distribution, typically to a rollover IRA, if the participant does make an election. And that is very easy to end up getting forfeited to the state, kind of indirectly or in a vague way. So watch out for abandoned property problems there. We have some key issues. Now, also, we're going to deal with a request for enhanced participant communication. Based on the Government Accounting Office feedback, the notices are now clear. Notice explicitly details 4 choices: leave it, roll to a new employer, roll to an IRA, or cash out lump sum. And while not required by statute, the IRS and Treasury are encouraging administrators to provide this notice specifically when a participant separates from service. Right? So they're saying it would make more sense. Now, this text clarifies the 60-day rollover trap. If the participant takes the check, 20% is going to be withheld. And if you want to not pay tax on the distribution, you got to make up the 20% from other sources to complete your rollover within 60 days. It also clarifies that after-tax contributions are rolled over first and are not taxed. And the administrator should remove sections that don't apply from those. For instance, if your plan has no employer stock, delete the net unrealized appreciation section of the notice. It's irrelevant. You can delete things that are irrelevant. The idea is, because if you don't do that, you're going to confuse everybody. Because, okay, I want to do this NUA. No, you can't do this NUA thing. There is no NUA in there. So it's there. We have a little cheat sheet here. It's a visual for clients to help understand the tax friction at each point. Direct rollover, no friction, 60-day withholding, friction, and cash out. Then there is the tax plus the penalty friction. So, I have to make things up and things that are problems. So anyway, as you may see fit to work with that. Okay, next up. Well, it took 40 years, but we are now going to again have access to a group tax exemption framework. Right? Revenue Procedure 2026-8 came out on January the 15th. This is basically a sleeper development, but it's significant for certain nonprofit organizations, tax exempts. We have the first update in 40 years. Okay. This replaces Revenue Procedure 80, the 1980, 27. The IRS wants better transparency. Now, back in 2020, the IRS stopped doing these group exemption requests, and they said until they got it updated, they were going to not accept them. That moratorium will end on Tuesday, January the 20th, 2026. So you can now go and get a group exemption. This isn't going to apply to a lot of people, but it will apply to some of you there. Okay. Now, couple of things in the revenue procedure, right? First, to be able to get a group, basically, to be able to get a group letter, you must have at least 5 subordinate organizations under the main organization. So there has to be a central organization, 5 subordinates, at least 5. You have 4, you don't qualify for this, everybody goes and gets their own. Also, a central organization can only maintain one group exemption letter. If you have multiple letters for different types of subordinates, you'll have to consolidate down to just one. Right? So you can't go get these letters separately. You're going to need to have only a single outstanding, essentially group letter. That's going to be your requirement there. Now, there also are supervision and control standards, right? The central organization must annually review finances and activities, right? So it's got to also, you got to annually, in this case, transmit the written info or educate subordinates on what they need to do to maintain status. The IRS explicitly stated that merely collecting a Form 990N, the postcard, is not sufficient to satisfy financial review requirements. You can't just say, oh, just give us what 990N be. Central organizations need to see real financial data, right? You got to be in control. And it controls established for this board organization by either appointing a majority of the board or a written agreement that evidences that this top organization has control, even if it doesn't appoint the board. Uniformity and exclusion provisions. Matching all subordinates must be in the same paragraph of 501c, XT3. You can't mix and match the C's. They must share a uniform purpose statement in their governing documents. And private foundations and type 3 supporting organizations cannot be in a group exemption. Purpose. Now, the procedural transition, it will now be done via e-filing, basically through through the pay.gov site, right? Be Form 8940. The supplemental group filing must be filed annually. Should say the supplemental group ruling information must be filed annually. And any pre-existing groups have until January 22nd, 2027 to come into compliance with the new rules. If you have a pre-existing group letter, but you have multiple group letters, you're going to have to consolidate into one by January 22nd, 2027. So essentially, you have a year to get yourself into compliance with that. And we have a nice little, again, picture showing you the rule of five subordinates and the supervision requirements to maintain a group tax exemption. So again, a nice little thing to look at there. You want to have it. Looks good. You've got it there if you're watching the video. If you're listening to this only on audio, well, you can go get the video. It's over there on the website, currentfederaltaxdevelopments.com. So you can watch it there. You can watch it also. It's on YouTube and it's on Vimeo. You have it all those places you can go look at. Finally, the IRS issued a news release on basically Friday, on January the 16th, news release IR 2026-09, and it's going to deal with the tax status of supplemental military housing allowances that were paid out this year. Okay. This is just a very quick update regarding armed forces taxation. One clarification, a reminder of some of the other parts of it. Okay. Now, the real thing this was issued for is what's referred to as the warrior dividend. If you may remember, you may have read recently, there was a $1,776 supplemental basic allowance for housing that was basically created by the president from funds that were appropriated broadly for housing in the, under the One Big Beautiful Bill Act. Okay. Now, uniformed service members 06 and below and eligible reserve members will receive this $1,776 payment. The payments are made in December of 2025, so that's when they got them. The IRS confirms that payment they got in December is not taxable. They do not need to report it as taxable, right? That's going to be the issue, that we get it on that point. And so essentially, the IRS is confirming in this news release that they ruled these specific payments are not taxable. They're simply supplemental housing allowances and are exempt under those rules. Now, what's the statutory basis for what they just did? It's found in section 134. 134, which states generally that gross income shall not include any qualified military benefit. Now, to be a qualified military benefit, the benefit must satisfy two conditions. It must be received by reason of service, check for this one, and it must be a benefit that was excluded from gross income as of September 9, 1986. So Congress froze the list of tax-free military perks at that date to prevent the creation of new tax-free compensations described as allowances. In essence, Congress has got to go back and essentially add things if you want them added. So now the question becomes, wait, this warrior dividend, how can it be excluded? This appears to be exactly the sort of thing that 134 says isn't going to count. Well, it's characterized as a basic house allowance, or BAH. Since housing allowances are excludable, essentially were excludable, right, in 1986, they remain excludable today. And how that's true is based on what's called the adjustment rule. Right? Section 134B3B allows for adjustments, basically, in cash benefits as long as the adjustment is determined by reference to fluctuation in cost, price, or similar indices. The benefit retains its tax-free character. This provision allows housing allowances to rise with inflation or specific bumps like this one without triggering taxation. So that's how they're getting it through as non-taxable, right? Is under that basis. Now, some planning considerations in the movie are in this. We do reference in an article in basically the 2016 version, December 2016 version of the Tax Advisor by Hannah Beget, or I'm sorry, Hannah, I mispronounced your name. They're talking about the basic allowance for housing is generally excluded from the W-2. And you should see, therefore, you should not see this payment being added to box one. Hopefully the military pay people got the memo and it's not in there. But it shouldn't be there, right? If you're like, look, and if you're doing some planning right now for your client, of course, after April 15th, and after 15th, but after January 31st, but you've got like their pay stubs, and you see this extra 1776 that came in, you should realize that that's not going to be considered taxable, right? There is a double dip exception. This is interesting. We're allowed to get a double benefit. Under Section 265, you cannot deduct expenses, allocated tax-exempt income. However, Section 265A6 Cap A provides a specific statutory exemption for military housing allowances. There's a similar one for the minister's housing allowance as well. Going to find the same sort of exception there. So that means they can use this or dividend to pay their mortgage interest and property taxes and still fully deduct all those expenses on Schedule A. The receipt of tax-free money does not reduce their deductions. It's a special exception. Now, verification, you might consider double checking, to take a look at their leave and earnings statements for December 2025, verify the supplemental payment was coded correctly as non-taxable allowance, not inadvertently lumped into taxable wages. As I said, they shouldn't make that mistake, but we've had a few odd things over the years with certain things coming through the military and them not actually getting the right income number reported or failing to pick up exclusions. Double check. Probably helpful if you double check that, right? And for broader context on various things that can be excluded from military pay, combat pay, hazardous duty pay, and allowances, you can take a look at IRS Publication 3, the Armed Forces Tax Guide. The version for 2025 returns of that guide is now on the IRS website, so it's there. Finally, this rule is pretty straightforward. All the IRS is talking about was $1,776 supplemental payment received by service members in December of 2025 should be fully excluded from their taxable income, should not be in their W-2, right? You can rely on 134 as the backup to the IRS notice because, again, the IRS notice is not really binding on the courts because they don't have the right to change the law by fiat. But there is a way to back this up under Section 134. There's no ambiguity regarding the federal treatment of this distribution. Now, as I said, theoretically, could a state take a different position? You'll have to check. I believe most states will follow 134. In this case, it would be very tough not to, because it'd be very tough to even get the information to try to not follow it. So basically, it's there. You might actually get some good news to your clients. Just tell them, that amount you got. They're in the military, they're 06 or below. Hey, did you get that extra $1,776? Yeah, that's the good news is that's not taxable, right? In essence. So those with 06 below and reservists in eligible categories confirm they receive the payment and ensure they provide their December leave and earning statements so we can make sure that amount was excluded from what's on their W-2. Get that together. And our infographic for this section, this is just looking at the general rules, some of the special cases of what you get that is taxable or non-taxable. If you have a client who is in the military, we talk about those pay, the things that are taxable, your active duty pay, generally, your retirement bonuses, and hazardous duty pay. Reinstate bonuses, I say, and hazardous duty pay are taxable, but if it's combat zone pay, that's excludable. The housing allowance and moving and travel deductions are excludable. And then the various things that happen there with housing, and filing protections, all of those on the other side. So this is kind of just a quick summary of the special tax rules military service guys have. Yeah, turns out Notebook LM is good at kind of being able to take these things and create a nice picture, right? A nice infographic of what we're talking about here. So I've had it do it, create this for this. Well, thank you for joining us this week. This has been the Current Tax Developments for the week of January 19th. We will see you next week for more developments. If you do have questions, my email address is there on the screen, on the slide. Ed Zollers at currentprotectiondevelopments.com. I also do participate in the Connect sites for Arizona, New Jersey, Minnesota, Illinois, Idaho, Washington. So if you're a member there, you can post something, and if I see it, I may respond to it. Otherwise, we will see you all here in another week at the 26th. Next week, remember, on the 26th, that is the first day you can electronically file returns. Still not sure they're really going to be able to do much of anything then, because I don't know about you, but I'm expecting I'm going to discover from my tax software vendor that a whole bunch of forms aren't currently fileable. And so we'll be stuck with that. But you might be able to file some very simple ones next week. So if so, that's when it starts. And so until then, we, take care, have good fun with your taxes. I'm sure it's just something exciting and thrilling, and you just can't wait to get started on. We'll see you back here next week for current federal tax developments.